You know, if you walked into a casino and you watched a guy just flip a standard coin and it landed on heads like 10 times in a row, you probably just think, wow, that is incredibly lucky.
Oh, yeah, for sure. I mean, it happens. It's a rare statistical variance, but, it's definitely within the realm of possibility.
Right. But if he stood there and flipped that exact same coin 1,000,000 times and it came up heads almost every single time.
Well, you wouldn't call it luck anymore.
Exactly. You'd say the fundamental laws of physics in that room are just completely broken, or, the coin is loaded. You'd know some other mechanism is driving that outcome.
Yeah, you're forced to just completely abandon the idea of chance at that point.
And that casino scenario, it's perfectly analogous to how the academic finance world looks at the subject of our deep dive today. So we're looking at a stack of incredibly rich source material, primarily The Warren Buffett Way by Robert G. Hagstrom.
Great book.
Alongside some brilliant forewords from investment legends, like Howard Marks and Peter Lynch. And our mission today is to decode what looks like a literal mathematical impossibility, which is the enduring success of Warren Buffett.
It really is a genuine anomaly. I mean, to understand how wild his track record actually is, you got to look at the efficient market hypothesis.
Oh, right, from the Chicago School.
Exactly, the Chicago School of Economics. That hypothesis basically argues that because there are millions of investors constantly processing all available public info, the stock market is perfectly efficient.
Right.
Therefore, they argue, it is mathematically impossible for anyone to consistently beat the market average over the long term.
Yet somehow, Buffett started a partnership with, $105,000? Right. And built it into an investment behemoth that, at the time of these writings, had a net worth of $143 billion.
That's staggering.
Statisticians actually call this a 5 sigma event, like a statistical anomaly so extreme it practically shouldn't exist in nature.
Okay, let's unpack this. How does someone actually do that?
Well, that question is exactly why you, listening to this right now, should care. Because this deep dive isn't just some narrow guide to picking stocks or reading a balance sheet.
Wow, it's way bigger than that.
Right. What Buffett actually provides in these pages is, it's a masterclass in rational decision-making, emotional control, and just cutting through the noise in a world that is suffering from massive information overload.
Yeah, it's really a whole philosophy of thinking. And Buffett himself is surprisingly humble about the origins of his wealth, isn't he?
Very. I mean, he claims his success basically boils down to winning what he calls the ovarian lottery.
The ovarian lottery. I love that phrase.
Great, right. Meaning he was just lucky to be born in 1930s America, a system that uniquely rewards the allocation of capital. And he attributes the rest of it to just the simple math of compound interest. And he actually outright claims you do not need a 160 IQ to succeed. In fact, if you have a 160 IQ, he jokes that you should sell 30 points to someone else.
Yeah. Because the extra brain power just gets in the way.
Right. So supreme intelligence isn't the differentiator here.
No, it's not. It's really about a synthesized worldview. To understand his actual system today, we first have to understand that he didn't invent his philosophy in a vacuum.
Right. He had mentors.
Exactly. He actively synthesized 3 distinct and honestly sometimes totally opposing worldviews to build his ultimate playbook.
But before we even get to those mentors, I think we have to look at how his brain was wired from childhood, because he always appreciated numbers.
Oh, from day one.
There's this amazing detail in the sources. When he was a little kid, his Aunt Alice gave him a stopwatch if he promised to eat his asparagus. And he took that stopwatch and used it to meticulously time and record marble races in his bathtub.
That's just wild.
I know. And then, for Christmas, he gets a nickel-coated money changer. Like the kind old bus drivers used to wear on their belts.
Oh, yeah, the metal ones.
Yeah. He straps it to his belt and he's selling gum, soda, and magazines door to door, literally calculating his return on investment as a child.
He was just captivated by the physical mechanics of money and probability from the very beginning.
And that obsession led to his first stock purchase at age 11.
11 years old.
Yeah. He buys 3 shares of Citi Service Preferred. He buys in at $38 a share. And almost immediately, the market drops. His stock falls to $27.
Ouch.
And his older sister is pestering him about the falling price every single day. The pressure is really on him. So the moment the stock recovers to $40 a share, he just sells it.
Just to get out.
Right. He makes a tiny $5 total profit just to relieve the anxiety. But then, right after he sells, the stock absolutely rockets to $202 a share.
Man, a brutal but totally necessary lesson for an 11-year-old.
Definitely. It instilled his very first great rule, absolute patience. He learned not to be sidetracked by the price he initially paid and never to settle for tiny profits just to relieve the psychological stress of holding on to an asset.
Which perfectly primed him for the first of his 3 major intellectual influences. Because when Buffett went to Columbia University, he studied under Benjamin Graham.
The legend himself.
Yeah. Graham is widely considered the father of financial analysis. Before him, picking stocks was largely based on rumors and, gambling, basically.
Just throwing darts at a board?
Pretty much. But Graham provided a strictly quantitative anchor, which he called the margin of safety.
Right. So the idea is that you calculate exactly what a company's hard assets are worth, right? The buildings, the cash, the inventory. And you buy the stock only if it's selling for significantly less than that intrinsic number.
Yes, you're trying to buy $1 for 50 cents.
That's the core of it. And Graham loved what Buffett later called cigar butts.
The cigar butt strategy.
Yeah, so imagine walking down the street and seeing a discarded cigar butt on the ground. It's ugly, it's soggy, but it has one free puff left in it.
Right.
So Graham looked for these deeply out of favor companies selling for less than 2/3 of their net asset value. The strategy was to buy them cheap, get that one last free puff of profit as the market naturally corrects the price, and then just discard them and look for the next one.
And, Graham's approach makes logical sense on a spreadsheet. But honestly, it sounds exhausting.
Very exhausting.
You're constantly hunting for discarded garbage, taking one puff and throwing it away. You never actually build anything sustainable, which is probably why Buffett eventually gravitated toward his second influence, Philip Fisher.
Fisher was the exact opposite of Graham.
Completely. Fisher was the qualitative guru. He didn't care about cheap, hard assets. He cared about what he called scuttlebutt.
Scuttlebutt, meaning going out into the real world and talking to competitors, suppliers, and former employees.
It's exactly. Investigating the actual business. Fisher wanted capable, deeply honest management, low-cost production, and massive future growth potential.
So it's a completely divergent philosophy. Graham just looked at the historical spreadsheets to protect his downside, but Fisher looked at the people and the future potential to maximize his upside.
Right.
So if I'm understanding the tension here, Graham is going to a junkyard and buying a rusty, broken down used car just because it costs $50.
Yep.
But it happens to have $60 worth of gas in the tank. You drain the gas, make a $10 profit, and scrap the car.
That's the cigar butt.
But Fisher is walking into a dealership and happily paying full retail price for a Ferrari because for a fact its engineering will win every race for the next 10 years.
That's a great analogy.
So that serious cognitive dissonance. Graham wants cheap safety, Fisher wants expensive quality. How did a guy obsessed with strict math justify reconciling those two opposite ideas?
Well, he needed a catalyst to bridge that gap, and that missing link was his longtime partner, Charlie Munger. Yeah. Munger had a background in law and a really deep multidisciplinary understanding of psychology and, worldly wisdom. Munger is the one who finally shifted Buffett away from Graham's rigid junkyard bargain hunting.
He kind of broke the spell.
He did. Munger convinced him of a psychological principle that would ultimately define Berkshire Hathaway. He said, it is far better to pay a fair price for a great company than a great price for a fair company.
And that shift in thinking directly leads to their famous 1972 purchase of See's candies, doesn't it?
It absolutely does.
Because for See's, they actually paid a premium. They paid more than the hard physical assets of the candy kitchens were actually worth, which goes completely against the Benjamin Graham rulebook.
They did. And they did it because Munger helped Buffett see that they were paying for pure quality and something called economic goodwill.
Economic goodwill? What is that, essentially? Pricing power?
Essentially, yes. Pricing power. They realized that a brand like See's had such a strong psychological hold on its customers that people wouldn't just switch to a competitor's boxed chocolates on Valentine's Day just to save a few pennies.
Right. If you buy your wife cheap drugstore chocolate to save $2, you're going to have a bad Valentine's Day.
Exactly. That pricing power is an invisible asset. It doesn't show up on a traditional balance sheet, but it guarantees future cash.
Okay, here's where it gets really interesting. Armed with this synthesized worldview, part Graham's strict math, part Fisher's management focus, and part Munger's psychological insight, Buffett developed a concrete checklist.
The playbook.
Right, a playbook of 12 immutable tenets for evaluating reality, divided into business, management, financial, and market principles.
And the foundational business tenet is to view a stock not as a piece of paper that wiggles around on a computer screen, but as a fractional interest in a real living business.
And it has to be simple. If he doesn't fully understand how the business makes money, he just walks away. He also strictly avoids turnarounds. There's a great quote in the sources. Turnarounds seldom turn. Instead of fixing broken companies, he looks for a moat.
The moat is crucial. It's a structural competitive advantage that protects the business from rivals. Buffett loves to imagine a beautiful economic castle, which is the core business, surrounded by a wide, deep moat filled with piranhas and crocodiles.
I love that image.
Right. If a business has a patent or an iconic brand or a massive low-cost advantage that no one else can replicate, that is the moat keeping the invading competitors at bay.
But let me push back on the financial side of his checklist for a second.
Sure.
Because if I turn on CNBC or open literally any financial newspaper, all anyone on Wall Street is talking about is earnings per share, or EPS. Did the company beat EPS? Did they miss EPS? The sources say Buffett completely ignores that metric. Why would he turn his back on the universal scorecard of the stock market?
Because Buffett considers earnings per share to be a dangerous smokescreen.
Really? How so?
Think about the mechanics of it. A company can easily increase its earnings per share simply by keeping a bunch of its past profits and using them to grow the business.
Right.
It's like putting money in a savings account.
Okay.
Of course, the total interest grows because you added more money to the pile. It doesn't mean management is actually doing a highly efficient job with the capital.
Oh, I see. It masks inefficiency. So a company could be pouring millions into terrible low-return projects, but as long as the absolute dollar amount of profit ticks up slightly, the EPS looks good to Wall Street.
Precisely. That is the trap he avoids. Instead, Buffett looks at return on equity. And crucially, he wants to see high returns with little to no debt.
Let's pause on return on equity. If I'm a listener without a finance degree, how does that work, and why does debt ruin it?
Okay, so think of equity as the actual cash you use to open a lemonade stand. If you put in $100 of your own money and the stand makes $20 a year in profit, your return on equity is 20%.
Which is a great business.
Exactly. But let's say a rival stand also makes $20 a year, but the owner had to borrow $900 from the bank to build some massive mega stand just to get that same $20. That business is highly leveraged and inherently risky. Buffett wants the company generating high returns based solely on its own internal cash, not on borrowed money.
He also focuses heavily on something he calls owner earnings, right?
Yes.
The formula in the book is a company's net income plus depreciation minus capital expenditures. To break that down for everyone, depreciation is kind of an accounting fiction where you slowly write off the cost of an asset over time. But capital expenditures, or CapEx, is the real cash you have to spend right now just to keep the lights on.
Capital expenditures are the hidden killer of wealth.
Right. Imagine a delivery business that makes $1 million in profit on paper, but they have to spend $1 million every single year replacing broken trucks just to stay competitive and not lose ground.
Right, they're running in place.
Exactly. The owner doesn't actually get to keep anything. The business is eating its own cash just to survive.
And if we connect this to the bigger picture, this focus on real, tangible cash flow leads to one of Buffett's most elegant rules. The $1 premise.
The $1 premise.
Yes, it's a strict test of management's rationality. The premise basically states that for every single dollar of earnings the company retains, meaning they don't pay it out to shareholders as a dividend, it must eventually create at least $1 of market value.
Meaning, if a company makes $1 billion and management decides not to give that cash back to the investors, they better be using that $1 billion to invent a new product or buy a great subsidiary, something that makes the company worth more than $1 billion.
Exactly the standard they are held to. If management keeps the profits and invests them in bad projects, destroying value, they are failing. If they can't create more than $1 of value for every dollar they keep, they should return that cash to the shareholders so the shareholders can invest it somewhere better.
Which flows right into his management tenets. Because he is obsessed with candor.
He really is.
He loves managers who admit their mistakes openly. Buffett himself puts a mistake du jour section in his Berkshire annual reports, highlighting where he personally messed up. But beyond candor, he looks for managers who have the spine to resist what he calls the institutional imperative.
Oh, the institutional imperative is a fascinating psychological concept. It's the lemming-like tendency of corporate CEOs to mindlessly copy whatever their peers are doing.
Like middle school peer pressure, but with billions of dollars.
Basically, if 3 rival companies make a terrible overpriced acquisition just for the sake of growth, the CEO of the 4th company will feel immense pressure to do the exact same thing just to not look left out of the trend.
It's the corporate version of FOMO, fear of missing out. And honestly, it's not just CEOs. Anyone listening to this who felt pressured to buy a house at the absolute top of the market just because all their friends were buying houses, or who bought into a speculative crypto coin because their neighbors were doing it, knows exactly what the institutional imperative feels like.
Oh, yeah. We all feel it.
It is incredibly hard to stand still when everyone around you is running.
And that's why Buffett looks for managers who have the psychological fortitude to just say no to the herd.
So it's easy for us to sit here in a studio and talk about rationality and moats and resisting FOMO in a theoretical vacuum, right? But the real test of a philosophy is applying it when the rest of the world is completely panicking. Let's look at how this system actually works in the real world with some case studies.
Case studies are where the abstract rules become tangible. I love this part.
Me too. Let's look at the 1960s Allied crude vegetable oil scandal.
Oh, this is a wild piece of history.
It really is. So these fraudsters filled 5-story-high storage tanks, mostly with seawater, and then put just a little bit of actual salad oil floating on the very top.
A thin layer.
Right. So when the auditors came and dipped their measuring sticks in, they thought the tanks were completely full of valuable oil. And based on this fake collateral, American Express backed massive loans and ended up losing $58 million.
A huge sum back then.
Massive. Wall Street completely panicked. American Express stock tanked by 50%. Analysts were screaming that the company was doomed.
And what did Buffett do? He didn't read the panicked analyst reports. He applied Phil Fisher's scuttlebutt method.
He went out into the field.
Right. He actually went out into the world and hung out at the cash registers of restaurants in Omaha. And he just watched people paying for their meals.
Wow.
He realized that the average consumer didn't know or care about the salad oil scandal. They were still pulling out their American Express green cards to pay for dinner. The banks were still selling their traveler's checks.
So the core business, the actual franchise, was completely untouched by the Wall Street panic.
Exactly. The moat was intact.
So while everyone else is selling in terror, Buffett confidently takes 25% of his entire partnership's money and just buys American Express stock. He capitalized on the gap between market panic and business reality, and the stock ends up tripling.
It's just the perfect execution of Graham's margin of safety, combined with Fisher's understanding of consumer behavior. And we see this dynamic play out again in 1973 with the Washington Post Company.
Right.
The stock market was in a terrible broad slump, and the Post was selling at a massive discount to its intrinsic value. Buffett recognized the immense economic goodwill of the business model.
Right, because a dominant local newspaper in the 1970s was essentially an unregulated toll bridge.
That's a great way to put it.
If you wanted to sell a car or run an apartment in Washington, D.C., you had to pay the Washington Post to run an ad. There was no internet substitute. The pricing power was absolute.
The business model was stellar, but the management was equally impressive. Katharine Graham, the publisher, demonstrated peak rationality.
How so?
Well, she looked at the massive amounts of cash the paper was generating, and she looked at the landscape of overpriced media acquisitions her peers were making. And she completely resisted the institutional imperative. She refused to empire build.
She didn't just buy a bunch of random TV stations to feel big.
Exactly. Instead, she aggressively repurchased 43% of her own company's shares.
Because she realized the best investment she could possibly make was buying her own deeply undervalued stock. So by retiring those shares, the remaining shareholders, including Warren Buffett, suddenly owned a much larger slice of the pie without lifting a finger.
For every dollar she retained, she created massively more than $1 in market value. It was the $1 premise executed flawlessly.
But hold on, let me stop you there.
Sure.
Because I'm looking at the next case study in our sources, and it feels like a massive contradiction to the rules we literally just laid out.
Okay, let's hear it.
We just said one of his ironclad tenets is avoiding turnarounds. Turnarounds seldom turn. But in the mid-1970s, he buys Geico.
Geico.
Yeah. Geico was effectively bankrupt. Their stock had plummeted from $61 all the way down to $2 a share. Why in the world did a man who hates broken companies touch a business that was on life support?
Well, what's fascinating here is that Geico is the exception that actually proves his rule about moats.
Really?
Yes. Buffett realized that Geico's franchise wasn't broken. Their core competitive advantage was selling auto insurance directly to careful drivers without paying expensive agents. That low-cost structural advantage was still totally intact. They hadn't lost their moat. They were just bleeding cash because of terrible, undisciplined management decisions regarding pricing and keeping inadequate reserves.
So the engine of the car was fine, the driver was just drunk.
Exactly.
It wasn't the business model that needed turning around, it was the executive suite.
Right. And when a new CEO, Jack Byrne, came in, he brought immense rationality. He executed what he called Operation Bootstrap. He didn't try to sugarcoat the damage. He ruthlessly cut costs, closed 100 offices, and simply refused to write unprofitable policies anymore, even if it meant severely shrinking the company's overall market share.
Wow.
When Buffett saw that rational management was finally back in charge of a pristine franchise, he pounced.
And insurance is the ultimate business for Buffett because of a mechanical concept called float.
Yes. Float is essentially free leverage. When you buy auto insurance, you pay your premium up front. But the insurance company might not have to pay out a claim on that specific policy for months or even years.
Right.
In the meantime, they get to hold on to your money. That massive pool of waiting money is the float.
And you get to invest that float and keep the investment profits for yourself. It's like taking out a massive multi-billion-dollar loan to invest in the stock market. But instead of paying interest to a bank, the customers are actively paying you to hold their money.
It's genius.
The sources point out that Buffett later hired a brilliant manager named Ajit Jain, who eventually grew Berkshire's float to a staggering $34 billion. It's an unbelievable structural advantage.
And notice how all the disparate pieces of his philosophy finally fit together in these case studies, right?
Yeah, it all clicks.
You have a simple business with a deep moat, run by rational managers who understand capital allocation, bought at a price that provides a mathematical margin of safety.
So what does this all mean? When we zoom all the way out, the ultimate secret to the Warren Buffett way isn't some complex algorithmic formula or having a faster, high-frequency trading robot.
Yeah.
It is absolute, unwavering emotional discipline. It's the ability to treat shares of stock as real living businesses and having the sheer psychological courage to stand completely still while the rest of the herd runs off a cliff in a panic.
Ignoring the daily noise of the market and focusing entirely on the long-term fundamentals of the business.
And connecting this directly to you, the listener. The great takeaway here is that you do not need to be a Wall Street insider to succeed. You don't need a 160 IQ. But you do need to know your own circle of competence, and you have to stick to it with absolute strictness. If you don't understand exactly how a business makes its money, you don't buy it. Simple as that.
The framework is simple, but the psychological execution is usually where people fail.
Yeah.
And there's a story in the sources that perfectly encapsulates this difficulty, and it's something I really want the listener to mull over.
Yeah, let's hear it.
So Buffett was once speaking to a group of business students at Notre Dame. He put up a presentation slide showing the names of 37 different investment banking firms. And every single one of those 37 firms had failed and gone bankrupt.
37 out of 37.
Yes. And, as Buffett pointed out to the room, these firms operated in a market with massive expanding volume. The people running them had sky-high IQs. They were incredibly hardworking, and they had an intense, burning desire to succeed.
So all the raw ingredients were there.
All of them. So why did every single one of them fail? As Buffett told the students, it was the mindless imitation of their peers.
The institutional imperative strikes again.
Exactly. One firm does something risky but highly profitable in the short term. The other firms see that profit, and they are too afraid of looking foolish or missing out to just sit on the sidelines. So they abandon their own rational metrics, copy the risky behavior, and they all march off the cliff together.
This raises an important question for anyone listening. We all operate in environments with immense peer pressure, right? Whether it's in our careers, our personal investments, or even just our daily life choices.
Always.
Are you making truly rational choices based on your own independent analysis of the facts? Or are you just falling victim to the institutional imperative, doing things simply because everyone else around you is doing them?
Are you flipping the loaded coin of the crowd, or are you actually looking at the physics of the room?
It's a heavy question, but if you want to navigate the world with the clarity of a 5 Sigma event, it's really the only question that matters. Thanks for joining us on this deep dive. We'll see you next time.